Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to another episode of Investment Matters. I'm your host Adnan Bazir, and in tonight's lineup we'll be doing the weekly market update with Abdur Rauf Hanslow, and then we'll have our discussion on investment analysis with Abdulaziz Davids, and we'll continue our series on financial planning with Mohammed Jaffer from Mojaf Financial Services. So do stay tuned as Abdur Rauf will be taking us through the weekly market update. Shukran. Assalamu alaikum and welcome back to Investment Matters. We'll be starting our discussion on investment analysis with Abdulaziz Davids. He is the head of research at Kagiso Asset Management. Assalamu alaikum, Abdul.
Wa alaikum salam wa rahmatullahi wa barakatuh, Adnan, and to our viewers as well.
Wa alaikum salam. Abdul, in terms of the Kagiso Islamic funds, investment funds, the Islamic Equity and Islamic Balance Fund, and just to sort of set the tone for our discussion tonight is to look at one of the companies that you hold within these portfolios, which is called Cisco.
Yeah.
Let's maybe just start off about the company, the history, etc.
Yeah, maybe before we do that, and shukran for that, Adnan, is to just give, last week we spoke about the South African equity market and foreigners in our market. I think it's important to just give the rationale for going and investing in a company that is not listed here. As we've expressed last week, we are quite wary and cautious on the South African market, especially in the industrial market. We find it ironic that while the foreigners come into our local market, we find opportunities in their markets. And part of the problem and part of the reason for that is that it's all about perceived growth. So Cisco, as you rightly say, is a company that has been around. I think it was started in 1984, late 1984. So it's I think this year will be its 29th year. So it's it's been around the block. It's one of the big IT companies, both in the US and on a global basis. And the big thing about Cisco is that it actually supplies quite a few of the hardware that makes both telecommunications to technology work. So, for example, the origins of Cisco had these foundations in supplying routers, or routers as the Americans call it. And these are big sort of hardware pieces that goes into telecommunications networks, what they call local area networks, etc. They've also expanded into what they call switches. So switches, for example, goes into your telecommunications networks. So with the advent of mobile telephony on a global scale, that sort of technology has come to the fore. Right now, with the evolution of technology, we've seen the world going from first generation, what they call 1G, to second generation 2G, and then third generation. Right now, in South Africa, Vodacom and MTN, for example, they've rolled out the LTE networks, what they call long-term evolution networks. All of this technical speak, and I'm not really a funny on this technical side of things, basically means that you're creating new demand and overlapping this new sort of products and surpassing the older sort of generation products. Cisco is at the forefront of that. So their what they call the next generation of switches, for example, and typically with technology, your processing power increases, your speeds, your efficiencies, all of those things are in place. And fortunately for Cisco, they've been able to transcend that evolution fairly effectively. The big thing that we're seeing, and part of the reason why we suspect that Cisco has been derated and the valuations have become more attractive, is the advent of mobile devices. I see you've got your iPad, for example. Yes. So mobile devices like iPhones and tablets and all of these things means that there's a perception that Cisco will obviously lose market share and will obviously lose out in that sort of evolution. We don't think that that is the case. We in fact see great opportunity for them because a lot of these mobile devices require access to networks. It requires connectedness, and LTE, for example, is a big sort of draw card on that scale. So clearly, if you want to have video telephony, for example, and high quality video telephony, you need LTE networks, and Cisco is a company that will provide those switches for that as well.
So, I mean, it seems like Cisco actually provides the infrastructure and support for the likes of the players such as Apple and Samsung, etc. I mean, with all the devices, they need to offer connectivity for the customers. I mean, what sort of other drivers are there that's key, I mean, in terms of the Kagiso investment research? that's making this quite an attractive company.
Yes. Yeah. I mean, obviously, we've spoken about the qualitative aspects of Cisco. It's a globally diversified business. I mean, they've got operations throughout the world. If you look at the Cisco business model, they tend to partner with, locally, for example, they've got Dimension Data and DataTech as their partners. So they focus on what they do best in terms of developing products, manufacturing those products, and they leave the distribution of those up to other players. So you've got a high quality and high class business model, and obviously given they spend on what they call research and development or R&D, there's always continuous reinvention of new products and services. So that is one of the key drivers of our investment case of Cisco, is that the company will continuously, and we believe that we're currently in transition period. We're transitioning from a PC world to potentially a post-PC world or personal computer world. But more importantly, I think from a valuation point of view, if you look at where Cisco is trading, in the past programs we talked about PE ratios, the price-earnings ratios. Yeah. To give our viewers a sense of a low PE ratio, obviously all things being equal, can be more attractive than a high PE ratio. Cisco is trading at a bigger discount to the American market, but more importantly to the South African market in terms of its PE ratio. It's grew its earnings last year. It has a stable dividend that it pays. So those fundamental sort of metrics that we typically look at, we find it quite attractive.
So I mean, overall, technology companies in foreign markets with Cisco, I mean, it's still being quite attractive.
That's right. And I think, like I said earlier, the reason why we think Cisco has been sort of fallen out of favor is because there's a perception that, and we've almost seen this wealth transfer between a Cisco and an Apple, for example. Yes. Apple has really taken off in terms of its market value. All the other companies like a Cisco, Microsoft, they've obviously lagged. And part of that reason is because we think that those investors are looking at Cisco as an ex-growth company. And we've seen in the last year they've grown their earnings. They've continued to develop new products. They're selling LTE services and networks. So we believe that derating is overdone, and there is a future for Cisco in a post-PC world as well.
I mean, and in terms of your foreign exposure, just to sort of end off, what sort of key other stocks are you sort of looking at in terms of your Islamic holdings?
Yes. What we've also seen as a sub-theme is that what's been happening in the US in particular is that a lot of companies are sitting on a lot of cash. Yes. So there's underspending in terms of the capital expenditures. So they're not investing in new networks. They're not investing in PCs. And that means that a lot of the demand has been delayed. And that impacts Cisco because it means that whereas they would have sold maybe X amount of routers last year, that demand has been delayed because companies are hesitant. Given the fiscal crisis that they had in the US, people want to have a wait-and-see approach. They much rather hold on to the cash rather than reinvest in the business. At some point, that investment has to come through. So we're looking at big technology companies that will benefit from that new wave of investment spend from corporates in the US as well.
Shukran for that, Abdul. Just ending with our investment analysis. After the break, we'll be continuing our financial planning discussion with Mohammed Shaffer. So do stay tuned. Shukran. Assalamu alaikum and welcome back to Investment Matters as we'll continue our series on financial planning with Mohammed Jaffer in the studio from Mojaf Financial Services. Assalamu alaikum, Mohammed.
Wa alaikum salam, Adnan, to you and to our beloved viewers.
Mohammed, we looked at the previous two episodes where we discussed the retirement planning and the type of retirement products that are available to investors out there. You talked about retirement annuities and the pension funds as well. And you briefly touched on the tax implications on these products when you invested in it. I think also probably another key aspect that the viewers would benefit from is with most of these retirement products, it's affiliated with being employed by a company and having the employer involved. In a situation where you're now wanting to maybe resign or you've been retrenched, etc. I mean, what happens with your retirement savings that you've now built up for, let's say, 5, 10, 15 years? What happens in that case?
Very good question, Adnan. In fact, that will also explain. I will also, by using this the question that you've posed, also explain the main difference between a retirement annuity and a pension fund. A retirement annuity, as we've said last week, you can never access the funds until after the age of 55 when you retire from the fund. Okay, where you have excess up to 1/3. When it comes to a pension fund, and you, for argument's sake, has been with this company, and unfortunately the company is now, you've been with the company for, say, 15 years or 10 years, and the company now, unfortunately, is going through some difficult times, and they now retrench you. Once you resign from the company or you're resigning from the pension fund, you've got two options, Adnan. The one option is that you can access the funds in full. If you access the funds in full, the fund will, whatever you are withdrawing will be taxed in full.
Okay.
Maybe you'll get a small tax break of about a couple of thousand rands, but thereafter it will be taxed in full. That's the one option. And in my opinion, that shouldn't be an option. In fact, the FSB, SARS, and the government is looking now at doing away with people accessing their retirement fund before retirement. In fact, only limiting it to the 1/3 withdrawal. The second option that you have is to transfer it to a preservation fund. Now you can transfer it to a pension preservation fund, and by transferring it to a pension preservation fund, you also have the latitude, the same as you've got the latitude in a retirement annuity, where you can select the underlying investments.
Okay.
So you've got that latitude there. The third option is to transfer it. So you've actually got three options. So the third option is to transfer it if the fund if the rules of the fund allows it, you can transfer it to your new employer. Why I prefer transferring it to a preservation fund is because you can select your own funds. Depending where in your economic active cycle you are, you can now select the funds that suits your needs and your risk profile, and not be boxed in to a fund that you will have to take. You've got maybe three options: aggressive, moderate, and conservative. Whereas if you go into a preservation fund, you have the latitude of a number of funds that you can invest that will suit your needs. So that deals with the pension fund, the main difference between a pension and a retirement annuity. Now also we must, as I have explained, that you get the tax break when it comes to a pension and a retirement annuity. As I said, if you contribute 1,000 rands to a retirement or a pension fund, a retirement annuity or a pension fund, and you're at the marginal rate of 40%, you are getting, of your 1,000 rands, SARS is contributing 400 and you are contributing the 600. When we look at the Provident Fund, now a Provident Fund is after-tax money. It's after your money has been taxed, you're now putting it into a Provident Fund. The main difference between a Provident Fund and a pension fund and a retirement annuity is that, firstly, which is exactly the same as a pension fund, when at the time of a retrenchment or retirement, you have access to the full funds. All right? That's the same with a pension fund. It's not the case with a retirement annuity. However, when it comes to retiring, at the time when you are retiring from the fund, you can now access, with a Provident Fund, you can access the full fund. And here again, because of the difficulty and the problems that we are facing in the retirement market in South Africa, again the FSB and SARS and the ministry is trying to do away with that, which I firmly believe should be done away with, because for argument's sake, people have worked 30 years, 35 years or 40 years. They get to their retirement stage, now they have access to a couple of million rands. They've never had the ability or the schooling to work with such a large sum of money. And what happens is that people then take the full funds, and in fact, I've come across where somebody was advised, and I don't call them advisors, I call these people salesmen, that this person was advised to take out the full pension fund and then invest it in a unit trust fund. Now, purely that is not the right advice, because a unit trust, depending on which unit trust you put your funds in, a unit trust is not constructed proper unit trust fund is not constructed for retirement purposes.
Yes.
You need to look at different unit trust funds
Yes.
for retirement purposes, because you don't want to sell off units when you're going to be getting your income on a monthly basis. You would want to live off the income that the fund is generating. So be very careful when it comes to those type of things, that you then do make the right moves and you place your investments in the correct investments. Because by doing the wrong, placing your money in the wrong investment at that point in time can be catastrophic, Adnan.
I think, Mohammed, just before we end off looking at still retirement planning, I think another aspect that many investors should also be aware of is how bringing your retirement planning in conjunction with estate planning.
Very good question, Adnan. In fact, it's a brilliant question. And on this, I think a lot of people overlook that your retirement planning can be used as an estate planning tool as well, because whatever you've placed in your pension funds does not get included in your estate. So when the executors does the estate analysis, they have to extract. They can firstly include it. They include it in your asset value, but then for your estate calculation, they take it out. Now you can use those people that's got discretionary money or extra money. A very good place to place your extra money is to place it into your retirement
Shukran for that, Mohammed.
products.
As we'll continue our financial planning series again next week, so do join us again next week. Shukran. Assalamu alaikum wa rahmatullahi wa barakatuh.